In this video, we are going to talk about dividend stocks from India. So before starting this video, please like this video and subscribe to this channel for our future updates. If you're looking for stock market information on the internet, you're probably ahead of 96% of Indians, since only 4% of Indians invest in the stock market. You're still in a stronger spot than other forms of investors and traders in the business if you're looking for what is the payout, dividend yield, highest dividend paying stocks, or best dividend stocks to purchase in the Indian market. Number 5. ITC Limited. ITC Limited, formerly known as Imperial Tobacco Company, began as a cigarette manufacturer, producing brands such as Gold Flake, Flake, and Classic. Among other things, it has grown into education and stationery goods, hospitality, paperboards, and packaging. Sunrise Foods Private Limited's acquisition is expected to boost the company's market position in the spice segment and increase its diversity. The company has consolidated its status as the leader in the Indian cigarettes market thanks to a strong brand, a diverse product range, a well-established distribution network, and a strong research and development capacity. Despite the rise in responsibilities, cigarette smokers' high brand loyalty has resulted in consistent market share and profitability over time. The financial risk profile has been improved by healthy internal cash accrual, low debt, and strong liquidity. ITC has a 34.52% operating margin. With a tangible net worth of over 59,084 crore rupees, the company has no debt. The company has maintained a dividend payout of over 50% for the past 10 years, with a present yield of 4.70%. It has a strong and stable dividend history, making it an excellent dividend bet. On the downside, the company faces regulatory threats in the tobacco industry, including tax increases, as well as competitive pressures in the FMCG market. The emphasis on cost efficiency and deep backward integration of different companies helps to mitigate these risks. You can't just choose the stocks with the highest yields if you're a dividend investor. That may sound counterintuitive, but businesses also pay out large dividends for a reason. There may be underlying market issues, or the dividend payout ratio is just too high, endangering future growth. The organization may have a debt-to-equity ratio that leads investors to believe it would fail in the long run. Number 4. SJVN. SJVN is a mini-Ratna corporation promoted by the Government of India, 59.92%, and the Government of HP, 26.85%, the public owns the remaining stake. It currently has a capacity of 2,014.5 megawatts installed and is planning projects with a capacity of 2,556 megawatts. Other hydro projects in SJVN's portfolio are currently undergoing survey and investigation, DPR planning, and feasibility study phases. Its flagship plant, the 1,500 MW Nathpa Jhakri Hydropower Project, HPP, has been operational for 15 years. In the past, the GoI and Go HP have shown their support for SJVN by making equity contributions. In addition, as a GoI organization, SJVN was able to obtain project debt financing from the World Bank at a cost-competitive rate. For both operating and under-construction projects, SJVN uses a cost-plus-tariff system, which ensures the recovery of fixed charges for debt servicing while also receiving controlled returns. SJVN has a 52% dividend payout ratio for the fiscal year ending in 2020. The company currently pays a dividend yield of 7.84%. The business has a strong dividend track record, having reported dividends on a regular basis for the past 5 years. With a healthy net cash balance, SJVN shareholders do not have anything to think about in terms of dividends in the immediate future. SJVN faces major project execution risks due to its large under-construction capability, 2,556 megawatts, completion within budgeted time and cost estimates. SJVN's expertise in designing similar ventures, on the other hand, mitigates these threats. SJVN is vulnerable to late payments from utilities with poor financials, more than a third of the allocated capacity. This is mitigated by SJVN's competitive cost of produced electricity, which has resulted in SJVN's debtor days being lower than those of other central public sector undertakings in the same industry. Number 3. Hindustan Zinc. The mined metal capacity of Hindustan Zinc is about 1.2 mtpa, with smelter capacities of 90,000 tpa for zinc, 205,000 TPA for lead, and 800 TPA for silver. It is the world's second-largest zinc miner and fourth-largest zinc smelter. It has a leading position in the domestic zinc industry, with a market share of over 75% by volume. Furthermore, high entry barriers, such as capital-intensive operations and a shortage of zinc ore mines, give the company risk profile a major competitive advantage. Exports accounted for about 20% of sales in fiscal 2020, demonstrating the importance of being present in global markets. Significant backward integration and low-cost, high-grade zinc reserves drive high operating performance. Across the whole supply chain, operations are incorporated. The mine's net reserve and capital were 403 MT as of March 31, 2020, guaranteeing a mine life of more than 25 years. The company should be able to sustain as a low-cost zinc producer over the medium term, thanks to long-term agreements with the Government of India, GOI, that give it access to the majority of lead-zinc deposits in Rajasthan. Since it supplies an important product, the COVID-19 lead lockdown had only a minor effect on its operations. Following the temporary effect of the lockdown in April 2020, the company saw a substantial increase in output and is now running at nearly full capacity. Furthermore, thanks to low-cost operations, a rise in export has offset a drop in domestic demand during the lockdown. A high net worth, good liquid surplus, and lack of long-term debt help the financial risk profile. As of March 31, 2020, cash and equivalents totaled 22,247 crore rupees. Dividend payouts at Vedanta Resources, on the other hand, are typically large in order to finance debt. In fiscal year 2020, the company's dividend payout ratio was 102.44%, resulting in a dividend yield of 7.09%. In the galvanized steel market, however, Hindustan Zinc is subject to cyclicality. Zinc demand is closely related to the galvanized steel industry, which consumes roughly 70% of India's zinc output. Zinc is also up against replacements for galvanized steel, such as aluminum and other alloys. The company's market profile also has a high concentration risk, as the zinc lead business accounts for over 75% of sales and profitability. Number 2. GAIL. GAIL has a 70% market share in natural gas transmission, thanks to its massive pipeline network of 12,200 kilometers. Pipeline construction necessitates major investments as well as managing a complex regulatory system. The Government of India has taken several measures to increase natural gas use, with the aim of raising natural gas share of the country's total energy mix to 15.0% from 6.5% currently. The city gas distribution, CGD, and the fertilizer sector are expected to continue to boost natural gas demand in the future. GAIL has also expanded into downstream industries such as petrochemicals and liquefied petroleum gas, LPG. The LPG segment has been helping GAIL sustain profitability and a healthy segmental contribution. Stable profitability and high cash accruals characterize GAIL's financial risk profile, resulting in comfortable debt metrics and capital structure. Over the last 10 years, the company's sales and earnings have risen at a CAGR of 11.95% and 8.92%, respectively. With a debt-equity ratio of 0.12, debt levels are still modest. In terms of dividends, the business has consistently maintained a dividend payout ratio of over 25%, which isn't particularly high, but its superior dividend yield of 4.4% justifies having GAIL in the model portfolio, making it a great dividend stock. On the other hand, the petrochemical, LPG, and LHC segments are vulnerable to commodity price danger, as low crude oil prices result in low petroleum product realizations. In addition, the company's tariffs are governed by government regulations. Number 1. Bajaj Auto. Bajaj Auto is a two-wheeler manufacturer with a long history of success. What sets Bajaj Auto apart from other Indian two-wheeler manufacturers is its unwavering emphasis on international markets. By not being too dependent on any one geography or product, the company has been able to de-risk its business. By far the largest motorcycle and three-wheeler exporter in India. From 28.2% in FY10 to 42% in FY20, the company's revenue share from exports has risen. It also maintains its market-leading position in the three-wheeler group. Bajaj, on the other hand, is a minor player in the scooter industry. Before the motorcycle boom in the 1990s, Bajaj Auto was the undisputed pioneer in the scooter industry. After that, Bajaj shut down its scooter company, but the scooter industry is booming. The company's expansion and presence in domestic and foreign markets has been fueled by its own brands as well as its partnership with KTM. With the launch of the iconic Chetak, Bajaj has recently entered the electric two-wheeler market, which could be a long-term growth driver. Over the span FY10-FY20, the company's sales grew at a CAGR of 10%, while profit after tax grew at a CAGR of 12%. With a ROAS of 29.61% and a ROE of 23.18%, the firm has superior return ratios. Apart from that, the company is a high-yielding dividend fund, with a payout ratio of 66.63% in FY20 and a dividend yield of 3%. Most notably, the firm has historically paid out over 40% of its net income as dividends. What do you think about our video? Do you want to add something to our list? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.